So look, I'm going to spend maybe a few minutes and provide a little bit of context in today's very exciting conversation with some really, really good speakers up here. Let me begin by saying, first of all, Happy New Year, and I hope everyone is healthy and safe, and I hope this year is a good one for everybody. Look, talking about VC, really what we're going to talk about is a little bit of a history on how we've done growth and innovation. And it's worth reminding the audience that in our 16 years that we've been around, we've done a fair number of interesting, innovative things. In phase one, it's hard to believe it's been 16 years. The establishment of the center was quite new, quite interesting, quite innovative, and the results have been, I think, outstanding, right? 27,000 people, almost 3,000 firms, nearly $300 billion in assets, kind of written out of here, a lot of AUM, close to $500 billion, a lot of premium, and more importantly, living up to our potential of essentially driving growth for Dubai. So we range between 4.5% to 5%, 5.5% GDP contribution. All of that has been a testimony to innovation that really worked. And then the question was, well, what else can we do? What's next? And so we figured out that getting that mix of talent and capital right made sense, and the world around us was changing. And so the last 3 years, I would submit to you, the audience, that we've been in the middle of this new phase on innovation, but it's been focused a lot on financial technology, which makes sense given that we are in fact a financial center. And I think a combination of some really, really innovative product development when it comes to our laws, some really, really amazing pioneering regulations from our DFSA, including things like money services, and of course today's topic of discussion, the VC framework, has really helped us. I mean, launching the FinTech Fund for $100 million, the region's first accelerator, partnerships with the FinTech Hive, partnerships with Startup Bootcamp. All of these things have yielded really, really amazing results. I mean, I'd say our market share now of FinTech with plus innovation is north of 50, maybe 60%. So we've managed to grow the numerator and the denominator, and you'll hear a bit more about this. Well, we've also managed to do, I think, relatively well, is really deep in the ecosystem. So for those of you who are not familiar with our innovation hub rather, check it out. It's a concentration of a who's who of companies doing really amazing things here. It's in Gate Avenue. So then the question is, what's next? What else do you do? Well, one of the things that we've learned is that it's not sequential. So that project continues, and even before it concludes, we're now thinking about the future. And for us, the term that you'll hear many of the panelists, or at least my colleagues, talk about the DIFC level is the future of finance, because that's what we're thinking of this. The future of innovation here is not just about fintech. It is about the future of finance. It is about looking at all things that will digitize this regional economy and drive growth, and that's what we're about. And you can't talk about growth really without capital, but it's not just about capital, it's expertise, right? So we have, I think last year, 580 or $600 million of venture capital was raised, I think, in the UAE. And what that tells you is that today's conversation is really interesting, not because you have a gathering of investment managers or asset managers talking about allocation of funds to particular sectors, but you have people who in some capacity, whether they're participants or advising, they're involved in the really amazing skill of identifying where growth is going to come from, and then really driving those firms and enabling the success of those firms. And as your venture capitalists will tell you, they guess right a lot of times, and often they miss opportunities, but that's part of the experience. And so the purpose of all of this preamble was to give the audience a sense of context, rather. We have been involved in the aggregation of capital and the best talent for the last 16 years, and it is our hope as a financial center that we continue that conversation in the next phase of growth, which really is about the expertise needed to grow the innovation sector and the future of finance. So without further ado, let me pass the mic back on to Mariam so that we can continue today's really amazing conversation. Thank you.
Thank you, Salman, for the introduction. Our next speaker is Christian Kuntz, Head of Group Strategy and Innovation at the DIFC Authority. Christian helps drive the Future of Finance agenda for the center and leads a number of initiatives on the intersection of financial services, technology, and innovation. Over to you, Christian.
Thank you, Mariam. And yeah, good afternoon, everybody. I'm very excited to be here today. I'm going to build a little bit on what Salman was elaborating on briefly. But before I start, I'm really excited about this session today because I joined the DFC in April last year. The day actually we all went on lockdown, and the first thing that Linda, Chris, and myself was working on, and the first board paper I wrote was the Venture Capital Framework, because we knew that there was a gap that we had. We knew that venture capital was extremely important for the startup ecosystem, and we wanted to make sure that we create the right environment for the future finance for venture capital from the DFC and from Dubai. And I was very happy how quickly we managed to collaborate and get this in effect in November. And I'm very, very excited to kind of talk about that today, to talk a little bit about what we're doing in the context of the future of finance. And also then hand over to Chris to talk about the framework. And then we have a very, very amazing panel with some of the people that I really admire in the ecosystem and that help shape the ecosystem since many, many, many years. So maybe just walking through the presentation quickly. So what Salman was alluding to was, and I'm not going to spend a lot of time on this, but was the DFC itself and how we've gotten where we are today over the last 17 years. Just to get everybody on the same page, I'd like to present or start off with this page, which tells you that 17 years ago the DFC was an unprecedented innovation because it was enacted under the federal law as a geographic area that was under the federal law exempt of federal civil and commercial laws applicable in the UAE. And that was the first financial free zone, and it's different to other free zones because we managed to get our own laws based on common English law, our own courts, and our own financial service regulator, the DFSA. And still today, that's quite unique globally. And I think what was the real purpose of this was to create an area in the Middle East that would be able to establish global standards and bring best practices to the region to attract top institutions around the world. And it started with the top kind of financial institutions and surroundings, and it moved on to the top startups and growth companies globally and in the region. And I think this is something that is the DNA of the DFC, and that's something that we started with, but we continuously reinvent and innovate. And I mean, some examples are our innovation testing license, which is different than other sandboxes in the region where you actually get a license, a full license with some restrictions, and over a longer period of time, the fintechs manage to remove the restrictions and get fully licensed. We have introduced new data protection laws last year, the only GDPR compliant ones in the region, and we're getting adequacy with UK and Europe, which means that they recognize our jurisdictions to process data in the same way, and cross-border exchange of data will be compliant and seamless. And there were new regulations like money services, but also like the VC framework and the digital assets that we're working on at the moment. And that really, I think, on the right side you see is just a testament to the companies that are basing themselves on global standards and want to operate on following global standards, and those companies came to the DIFC. And more and more, that's also including fintech and innovation, and this is a bit of the footprint. So we started with fintech, but we're going beyond fintech into kind of fintech and innovation, and that includes sort of the essence of future finance, and I'll talk a little bit about what that means for us. But this is just a snapshot of the 300 fintech and innovation entities that are registered in the DIFC. A large part, obviously, non-regulated, from SaaS solutions, platforms, payments, RegTech, wealth and asset management, analytics, AI, and so on. But we also have an increasing number of fintechs that are getting actually authorized and getting regulated. a large part in crowdfunding. That was one of the first, licenses that we introduced. More and more in payments, capital markets, wealth management, and so on. And we also have a large number, over 20, in our ITL program to date. This is a bit of the snapshot of who's there. And what I like about this is that it's a really great mix of global and regional fintech and innovation companies, early, mid, and late stage. And through the innovation hub that we now created and is coming together by end of this month, it's really an ecosystem of different types of growth and startups, but also then very closely to kind of the ecosystem enablers, the corporates, the government, the regulators, and now also with the Future District, the Dubai Future Foundation, Smart Dubai, and so on. So it's really an ecosystem coming together, and I'm very happy to shape that further. And I think VC is essential in that ecosystem, as all of you know very well. So what are we doing? We're actively investing a lot in building these new capabilities, enhancing our proposition to become a future finance hub for companies across 5 pillars. A few things, as mentioned, I think worth alluding to is one, our drive for innovation, and through the ITL and other programs I will highlight. Our very successful DFC FinTech Hive, now in the 4th cohort. And also with new programs like Accelerate Her, where we look at support female entrepreneurs, or the growth programs where we link up with VCs to help match making between some of the really exciting startups and a lot of you in the audience. And obviously regulations, laws are essential as well. And we created new innovation license packages. And specifically for VC portfolio companies, we have a market entry license. So if you want to learn more about that, that's even more subsidized. That is accessible, for example, for VC portfolio companies. So just reach out to us. We launched 8 initiatives last year during the pandemic to implement that strategy. And we're moving, a lot of them are moving forward at a very high pace. And maybe just to wrap up, I think on the first 2 areas I already elaborated, but a few things, especially on the innovation initiatives. There's a virtual platform we're working on, a few exciting things on the API and open finance space. But there's also a partnership we announced yesterday with the Center for Fourth Industrial Revolution, DFSA ourselves, on digital assets, digital securities and exchanges. There's different use cases that we're taking from policy recommendation through the sandbox into implementation and trying to really see what is the power of collaboration in that space. We also announced a partnership.
These economics, we've gotten feedback from a lot of our partners in Saudi Arabia, in the UAE, that these are sustainable numbers. We believe that we can hold these numbers for the next 2 years.
Can't hear you, Christian.
Can you hear me now?
Yep.
Yes.
Yeah, sorry, I think Mariam muted everybody since there was some noise. So there's a couple of exciting partnerships, one with the Center for Fourth Industrial Revolution, as mentioned, I think another one with MasterCard, and that's a global partnership with a global cyber and intelligence team, and we're going to do some really exciting things. And we're also doing more and more in the sustainable finance space. We're having another webinar end of the month where we're launching guides on sustainable investing and sustainable issuing. So lots of interesting things. Other topics include sort of the venture builder studios. I think it's a big trend, and we're doing some stuff that we will elaborate in the future more on, as well as the funds, as you know, are coming together, the new framework. And venture debt is something that's very close to our heart, and we're working on how we can develop that sector in collaboration with others in the region to really create an environment for growth. So that's it from my side for now, and I will pass it back to Mariam to hand over to Chris to talk a little bit more in detail about the new VC framework.
Thank you, Christian, for the insightful presentation. Our next speaker for today is Chris Cameron. Chris is the Director of Conduct and Supervision at the DFSA and overlooks conduct and financial crime risks. He is also the designer, if I may say, of the Venture Capital Framework and the absolute expert on the overarching funds regime. Over to you, Chris. Thank you.
Thank you, Miriam, and good afternoon, everyone. I'm delighted to be here today. Similar to Christian, very excited about the launch of the regime. We've done a lot of work over the last 9-10 months to get to this point, and already we're seeing quite a lot of inquiries going into the new year, and indeed some application forms that we're busy on that have come through already. So it's looking like a good start to the new year in the fund sector, and specifically on the launch of the venture capital regime. What I'd like to do today is just do a quick walkthrough with you in relation to the criteria that we've developed in the regime. And I think most importantly through that is also to talk you through the process, the timings and the cost. And I think those three kind of headings are probably the most key points for you to take away. Before I get to that kind of process, timing and costs, I'll talk through a little bit about the regime itself. So as Christian's mentioned, a key part of this for us to get involved was to facilitate the DIFC strategy with the future of finance. So that's a key component or key driver for us in terms of timing for launching the regime. We had monitored the launch of the Singaporean regime several years ago, and we've kind of closely watched that since. And we've always been able to launch venture capital funds in the centre, and indeed we've had several during that time. But we felt now was the time to actually look at reviewing the regime to try and facilitate that further and enable further growth in that segment. So it was a good driver, good trigger for us to implement the regime. In terms of what that looks like, very similar to the approach that we've adopted to date, anyone that's been around for the last kind of 6, 7, 8 years since we implemented the QIF regime. In essence, what we're doing is taking that a step further. We're taking the exempt and QIF regime processes, the timings, the cost, and streamlining them further. So you'll see very, very much similarities in terms of what we've been doing to date, but taking that a step further just to enable further in the VC space. So naturally what we needed to do was define what a venture capital fund is, so participants are then able to enter the regime to avail themselves of that streamlined kind of framework and procedure. So what we've done is defined it in essence whereby the fund needs to be investing in small to medium-sized businesses, and those businesses need to be in the early growth stages of business development. And as I mentioned at the outset, we would expect in some cases, and hopefully a lot of cases, there'll be innovative technologies and new ways of doing business in amongst those funds. But we've also provided the regime to cater for a far wider VC sector as well. So, you know, typical types of areas that you would expect to see, like food and beverages, etc. So it's a wide array of funds that we expect, but it should definitely facilitate DIFC's strategy. And then within that, we're also looking for the fund itself. If we think about kind of investment kind of restrictions or parameters and criteria, for 90% of that, for the fund to have committed capital invested into unlisted business ventures. And then what we're looking for is for those investments to be up to 10 years in kind of age from the initial point of investment in each of these ventures. Now also just
sorry, Chris, I think the gray box, if you could just move it to the side, I think some of the...
Is that better?
Yeah, perfect. Yeah, and another, yeah, much better. And the other smaller gray box, if possible.
I've got just a full screen. Can you see the full screen only now?
Yes, it's just the gray box. Thank you.
Okay. So as I mentioned at the outset, we've continued with a risk-based approach with the fund regime, with the venture capital space. Although venture capital investment in itself can be viewed as a higher risk investment, given the types of investors and participants in the marketplace that we expect to be involved in that space, we ourselves as a regulator, in terms of our risk tolerance, we view it as a lower risk area. And that's as a consequence of that, we're able to apply these streamlined processes and regulatory framework. You know, what we've put in place in essence is a high level principles based regime and driven by disclosure. through prospectuses, for instance. And then another area there's a couple of other areas that naturally then limit the risk to us, and importantly, enhance the investor protection element. So by going for exempt funds and QIF onlys, that's targeting professional clients only. There's no retail and there's no kind of volume of clients associated with those. And then to take that a step further, given the kind of buy and hold long-term nature of these investments, we've also required firms to adopt a closed-ended fund structure. And that then obviously deals with the possibilities around liquidity and redemption risks for the fund manager. So all that's kind of inherently catered for. What we've also done again to facilitate building the local industry for the country is to focus on domestic funds only in terms of the streamlined process and costs. And then the feedback that we've got through consultation, we did some good soft consultation before going into the policy process itself, and then a formal consultation. And participants have expressed the need for a partnership or a company to be the preferred type of legal structure, and that's both vehicles that we have in place in the centre. So that's all primed and ready to be used. What we then did was look at the regime a little bit further to see what further streamlining we could do, and thinking about the types of funds and inherent risks and size of funds that you would have with a VC as well. So, the buy and long-term hold, the types of investments that you're making don't necessarily require the same extent of service providers around them, such as a custodian, for instance. Not to say that you can't use a third party, but similar to what we've done with the policy positioning on real estate funds, private equity, we're allowing self-custody for these funds, should you wish to use that as an approach. And we use that based on you needing to have effective arrangements in place to ensure safeguarding of the assets of the fund vis-a-vis any other fund, the fund manager itself, and if there's ever an insolvency event at the fund manager, make sure those assets continue to be safeguarded to ensure investor protection. We then also had a look at some of the authorised individual roles that are associated with the firm. Now, if we look at the finance officer, there'll be a little bit more on the financials as I go through the slides. It's fair to say there's less to do on the financials from a regulatory perspective. So we feel that we can remove the requirement for a finance officer. Again, there's a cost, there's a process involved to ordinarily go through that, to have that person in place. Not to say that you can't have someone designated as a finance officer, but they don't require regulatory approval. And indeed, we'd be very comfortable with an SAO, for instance. If they've got that kind of background, they can do the projections, the ongoing yearly financials, etc. And as and when they need it, they can get a third party in. But there's not a requirement for a finance officer as such. And I think what's also key, if I may just pause before I go on to the next point, is one of the things that we looked at to be able to get comfortable with the removal of these points is typically the size of funds that VC get to. We're looking, generally speaking, there are exceptions, but 10, 20, $30 million is typically some of the sizes of funds that we've looked at and experiences that we've had looking at. Consequently, the revenue for the fund manager is lower as a consequence of the size of the fund. We're also mindful of the startup costs to get started. So with that last point in mind, what we did was look at some of the startup costs, and that was around an authorised individual for a compliance officer and MLRO, for instance. And we've given flexibility there. If you notify us through the application of this, then you don't need to employ one at day one. We'll expect you to have the relevant compliance and risk manuals in place. You could do that in-house, you could have a third party do it for you, entirely up to you. And you will need to run your business in a compliant manner. But having someone come in to monitor, whether it's in-house or a third party, we don't need them to be authorised to do that until you've got capital committed into the fund itself. And that's a trend that you'll see in subsequent slides as well. It's a key point. Once the capital is committed, then we expect certain things to come live and be in place. We also had a look at internal audit, and again, the nature and scale of activities, complexity of the business and the funds. We felt that that was perhaps an overextension to have that required, given typically we're looking at smaller firms, startups, and smaller funds as well. So it was important that we kind of disapplied that, if you like. Again, good practice not to prevent a firm putting that in place if they so wish, but it's not a requirement. And then also just to kind of facilitate DIFC's strategy, we're looking at a lot of kind of small tech firms, startups, VC experience, and we're willing to expand our kind of risk tolerance in relation to skills and experience, if you like. We haven't removed the principles of our regulatory framework. We need adequate resources at a firm in terms of human resources, relevant skills, experience, and are they suitable in terms of their background and clear background checks. But we know through our experience of real estate, private equity funds, for instance, that there can be a degree of concession and trade-off. You might come to us with 20 years of VC experience in a particular industry, but you may not have 20 years experience of funds. It might be a lot less than that. So on a case-by-case basis, we will work with you to understand the experience, and that risk tolerance is certainly widened for VC. I mentioned the financials earlier, and I think this is a...
For interrupting again, just this another small gray box. I think they can't read the bit at the bottom. If the gray box, I'm not sure if you can see it.
Yeah, it's good. Not there.
There, that's fine.
Yeah.
Nope.
Yep, you got it now?
Yep.
Perfect.
Yeah.
Keep it like that.
Apologies. So I think this is a very important takeaway, as well as the kind of streamlining of process and times and costs.
No, it's back.
I'm not seeing any.
You can just leave it this way, and we can share the slides post-event as well. Yeah. Perfect.
Keep it
Thank
as
you,
is,
Chris.
please. Thank you.
Yeah.
Okay. So one of the key components is the prudential requirements, and I think DIFC's done a lot on the premises aspect with the introduction of the innovation hub, and kind of flexible cost and desks and offices in that space. I think if we look at where we've introduced a significant cost saving is around the prudential requirements. If you look at a QIF manager, exempt fund manager at present, you've got a base capital requirement of $70,000. Your capital requirement is the higher of that, or the expenditure-based capital minimum, which is 13 weeks expense. We've actually waived that for VC managers. So upfront, that's a significant cost that's saved immediately. What we do ask in turn is that you ensure you've got liquidity available to be able to meet your liabilities as they fall due, and obviously thinking about the nature and scale and complexity of your business as that grows, ensuring that liquidity is there to meet that. So I think that's a significant shift for you to take away. I think also, just in reflection, I made the point earlier about capital being committed and as providing flexibility in that regard. Another area we've done similar with is on the reporting for funds. So anyone that's been in and around the fund space in the DIFC will know that all funds, whether it's public, exempt, QIF, are expected to provide a year-end report in the form of audited statements. Again, you will require this for a VC fund, but we will give you flexibility between the time that we approve the fund up until the capital is committed. It's only at the point at which the capital is committed we would expect you to start to turn your mind to the fund being audited. So again, we expect some notification engagement with you in the background once that turns live. We have, however, built in a safeguard that will also assist us, and I think it's important I just mention this while we're on this point. This isn't just for VC funds, but we're actually introducing a periodic fund return in July of this year. That will be applicable to any fund that's set up and managed from the DIFC, so both domestic and external funds. And that will be per fund that's managed by the manager. That will give us some indicators around some of the components that I've mentioned today and some other risk indicators. So that will also enable us to move into a more enhanced space in terms of risk-based approach as well. Last but not least, let me just address the process. Those of you that have been through the process in the past, you may have used the exempt or the QIF fund manager form, which is now online, the OT3 form. You'll still use the same form to come through if you're looking to be a newly licensed firm. What we'll do is ask certain questions up front, and then that will start to tailor the application form as you go through it and streamline it further for you. So everything's online. We don't require you to provide separate documentation such as business plans or financial projections. Anything that we would want to know about in a business plan, we're asking questions of you in the online form. And similar to any kind of projections, given we don't need capital requirements, we will look for your kind of revenue and expenses, but there's not the same kind of regulatory components alongside that. So the online form is your kind of key focus. What we've put in place is a process that will come straight through into a recommendation memo for us as you populate your form. And will enable us, if all the background checks are clear, there's no gaps in terms of what you've added to the form, we would like to try and get you there within 1 week of submission to the in-principle stage of licensing. Now, one of the things that we will put in place to enable you to come through that way is to restrict your license. And again, that's something we've been doing for 6-7 years now since the QIF regime was implemented to streamline it. We had a restriction to the license to restrict you to QIFs or exempt funds. We'll continue to do that, but we also add some narrative on there to the extent that it will be in relation to venture capital funds only. And once that's triggered, it sets out the application form further for us to put us on that kind of mindset. And also in terms of cost, we've reduced the fees significantly. We're looking at a $2,000 application fee for licensing, and then the same fee applies on a yearly basis. So that's a significant reduction for both, if you compare that to QIF, exempt, and public managers. I've also mentioned the premises. DIFC's done an awful lot of great work on the innovation hub. I often walk past there for my exercise when I'm in the centre at lunchtime, and it is a really cool looking set of premises. And it's there's a large set of premises there. What we've done is agreed with DIFC that for the next 12 months we'll allow VC managers to trial in there. We had a couple in there towards the tail end of last year. Given the current conditions, it's not often easy for people to be in place all the time, working remotely, etc. But for the rest of this year, we will allow VC managers to move in there to trial that and ensure that we can get comfortable around about that. That will be limited to the fixed desks and the small offices. And of course, any other offices, as is the norm in the DIFC, you'll be expected to be in the DIFC. I'll just finally touch on the fund process itself. The licensing process itself has changed quite significantly, as you can see. The fund application itself, that process has not changed. In essence, the funds that you would submit would be an exempt or a QIF. We've got a well-tested process and team to support that in place. Exempt funds, we've got a service standard of 5 days, 2 days for a QIF. To be honest, the team turn those funds around, both of them, in 1 to 2 days, unless there's any exceptions that we need to follow up in. But usually we can manage both questions and meetings within that service standard. So I'm very confident about that. Our key focus continues to be the prospectus. There's an online form and you would submit the constitution as well, but it's all about disclosure in the prospectus. And then just last, the fees. We continue to charge no fee for application, but we have reduced the ongoing annual fee for a fund down from $4,000 to $1,000. That's it for me. I'll hand back over to Miriam, and I'd be more than happy to take any questions at the end of the session, or if anyone wants to meet outside the session at a later date, happy to do that as well. Thank you very much for your time.
Thank you, Chris, for the informative presentation. I'm sure a lot of our audience members would like a copy of that, if that's okay, post-event. Now I'd like to hand it over back to Christian Kuntz, who will be moderating our panel discussion with the leading experts. Thank you so much.
Great. Thanks, Miriam. Thanks, Chris. So I would like to invite to the panel, first of all, Fred, who's the regional head of fund services for Maples Group in Middle East. Fred has overall responsibility for the Maples Group Fund Services business in the Middle East. He has more than 20 years of experience in financial services operations, fund administration, and reporting of a wide range of investment funds with expertise and knowledge of best practices in the operations of asset managers, service providers, and banks, including, of course, venture capital. So Fred, please, if you can show yourself. Then I would like to invite also James, James Stull. He's a partner with King and Spalding. James is in the private funds and capital markets practices and primarily focuses on fund formation, public and private capital raising transactions. And he regularly represents Middle East and international sponsors to establish conventional and Sharia compliant investment vehicles to invest in various asset classes, including venture capital, private equity, real estate, credit, and other alternative assets. Then I'd like to invite Khaled Talhouni. A lot of people, I'm sure, will know him very well. He launched his new VC fund, Nuwa Capital. Recently, Khaled is a career venture capitalist and currently managing partner of Nuwa Capital that is investing in technology-enabled companies in the MENAT region. Throughout his career, he has focused on building lasting partnerships with the entrepreneurs delivering the region's digital economy. Khaled has invested in many early stage transactions, over 60, I think, including the likes of Kareem, Little Bits, Mom's World, Insider, and Luxury Closet. And lastly, but not least, I would like to invite Walid Hanna, who's the founder and CEO of MEVP. Walid is the founder and CEO of MEVP. As mentioned, he has been active in the venture capital space and new venture development for the past 19 years, with over 50 plus VC investments executed since 2010. And he's grown the MEVP assets under management to over 300 million. He has himself co-founded, invested, led, and exited several startups in the region. So I'm very excited to hear more also from him in the panel. So thanks for all of you for joining the panel. I hope that everybody can see you and hear you. So I think we want to talk a little bit about sort of the trends in the region, the role of Dubai, and some of the benefits of the new framework. So maybe I'll start with James and Fred, and building on what Chris has just explained to us.
Sorry, Christian, can I ask all the panelists if they could turn on their cameras and their microphones as well, please? Thank you.
Thank you. Great. So maybe then we'll start with Fred because I can already see you. So Fred, what are the, in your opinion, and you've been involved in this process as well, like what are the biggest benefits of the new framework in your opinion?
Thanks, Chris. So we've seen significant development in the VC market in recent years. That's been established earlier by Salman, and I think from our perspective, there's been also rapid growth in the number of private and government-sponsored funds and initiatives, which really served as a growth catalyst in our business. I'd like to focus on the role of the government because we see them coming in as anchor investors in many of the funds that we service. There's still leading efforts to promote innovation, entrepreneurship, to support the startup ecosystem, and Walid can touch on that later on, I'm sure. There's obviously at the regional level a young population, and they're being equipped with a lot of support, skills, innovation hubs, and really programs to promote employment, promote innovation. Salman touched on that. So this is all very positive for the region, and innovation, I think, from what I see, continues to be a top agenda item for governments throughout the region, not just the UAE. We're seeing a lot of activity in Egypt, in Lebanon, in various Middle East countries. With respect to private managers, they are capturing investors' appetite to locate the next unicorn. And they have been extremely active scaling and making investments and tapping into a very diversified pool of investors led by government and quasi-government entities and family offices mainly to basically support bridging a massive funding gap. But I should also highlight that well-established managers who demonstrate commitment to the region have been a lot more successful in capturing these capital flows. But their long-term success really hinges on their ability to exit some of these investments successfully. That's what investors are really looking for. So that's important to highlight. With respect to emerging managers, we've seen a large number of emerging managers come into the marketplace. All of them, I can comfortably say that all of them faced significant barriers to entry when it comes to establishing regulated presence in the region, and mainly driven by significant upfront and operational cost barriers that Chris just touched on. I think the introduction of the DIFC VC framework addresses that in a big way, and it is a game changer. So we're very pleased with the speed it came to market. It was a very strong response, and I think it will continue to foster and develop the VC ecosystem. So just to summarize, I think private managers and emerging managers are the driving force behind this growth, but they're being supported by government-led initiatives and stimulus programs, and of course the private investor community.
Excellent. Thanks, Fred, for these insights. James, do you have something to add to this? What's your view on the benefits and also kind of how the industry is changing in terms of types of fund managers coming into the market, existing ones scaling up, internationals expanding? What's your view, James?
Sure. Thanks, Christian. So I really have to give credit to the mastermind of this framework, Chris. I think first and foremost, the legal regime is really helpful and gives a lot of flexibility. But I think for me, the obvious benefit, just first and foremost, is the cost. So many emerging managers, whether it's in VC or other sectors, they want to be in the DIFC. They want to be regulated. They want to say we are complying. But then they looked at the regulatory capital, the cost of having all sorts of employees. Just if you put this all together, and it sometimes adds up to be $500,000, and they say we're not even sure if we're going to be able to raise our fund and if we'll be successful, and we have to shell out $500,000 up front. This is just an untenable cost. And so I think the DIFC, I mean, it's maybe been something we've had conversations for a long time about, and I have to give the whole team credit for actually actioning something that can make this more palatable for first-time and emerging managers, where it may just be a couple people that have an idea. So I think that is absolutely the biggest change, and it doesn't surprise me in the slightest that Chris is saying you're already having a number of applications come in the door, even though the framework is relatively new. And I would say that's probably what I'm seeing the most in the region is more first-time managers, that individuals who had been either at companies or who had been mid-level senior management at a larger firm and are spinning off and doing something themselves. And I would say particularly coming from, let's say, in-demand sectors and realizing that they have specialized knowledge and maybe cybersecurity or something else, and saying, I'm going to go out and I'm going to set up a fund that specializes in this. And they're finding that people are very interested in this specialized knowledge. But again, they're smaller. They're not necessarily backed by huge, yet by some of the huge government programs that Fred has mentioned. Ultimately, the hope is they will be. But it's kind of, I think the new framework that puts in place allows people or will kind of encourage people to take some more risk right now that they maybe wouldn't have with higher cost to entry.
Very interesting. I think it's a good bridge to Khaled, as sort of, to some extent, the manager that you type of described, being part of the VC ecosystem for a long time, but now kind of launching your own fund. Khaled, like, what's your views and how do you see the VC landscape in MENA evolving?
Thanks, Christian, and thank you everyone for having us. I think there's just been such an incredible transformation in the VC and startup landscape in our region. And when I say our region, I really mean the wider region: the Middle East, North Africa, Turkey, Pakistan, even East Africa, which is kind of forms this larger locale. I think we went from maybe 10 years ago to hardly any VC funding and very, very few sort of companies at scale to what has become really an incredibly vibrant ecosystem with still a lot of room to grow. So I think that's changed very considerably. I think what we're seeing, particularly in the region, we're seeing globally and is being slowly reflected in the region as well, is really the democratization of access to capital. So basically, if you're a good company, you can raise money. So I think for us as investors, there is going to be a very strong paradigm shift in the way we add value to entrepreneurs. So basically leverage flows with the entrepreneurs rather than with capital. The entrepreneurs will be able to choose, and already doing so, who they want to work with, as they are the commodity, as they are the kind of valuable commodity, whereas the capital is just is accessible. So I think the biggest challenge in the VC landscape is how we need to think about adding value to the founders that we work with, and specialization. And I think the new VC framework allows for, I think someone mentioned a second ago, this focus on new fund managers experimenting with new types of investment thesis or with a new approach. And being able to make that easier, I think, is critical to driving the ecosystem forward as part of that overall paradigm shift.
Interesting. So maybe that's now trying to pull in Walid into the conversation. Walid, I think we all know that Dubai is still the number one in the region when it comes to VC funding into startups. And one metric I always like to look at, which is interesting, is if you look at kind of VC funding into Dubai startups as a percentage of GDP, which is 0.4%, and you compare it to China, which is 0.3%, and the US, which is 0.5%, Dubai is kind of punching above its weight when it comes to a metric like this. But at the same time, when you're kind of and you've been part of driving that over the past decades. So I was wondering, if you're at that level, we see now other regions like Saudi, accelerating. What does it take? What's sort of the next big game changer to increase deal flow, to get to the next level and scale up high impact ventures and funding in Dubai? What do you think is the next game changer here?
Well, I'd like to say that the new license you're doing with the VC funds and the DIFC is a game changer. It's good to have, but it's not a game changer. Listen, last year, according to Magnet, there was about $1 billion of VC investments. And yes, UAE had the bulk share as a country. Saudi was second, Egypt was third. But when we say UAE, it's really mainly Dubai. Dubai is like 80% of the funding in VC company and in technology companies in the UAE. So infrastructure, all of the enablers, the ecosystem, it's a hub. Dubai is a hub, and everybody wants to. I mean, we got approached by HGM. We're licensed there as well, but we're still based in Dubai. We're still based in the IFC. I'm very happy that we're gonna get rid of our Category 3C asset manager license, which is very, very expensive, and move to the new VC regime. This is very helpful. But we've been attracted by Dubai for hundreds of reasons. Nothing is going to change. I think Dubai will continue to grow and will continue to be the hub of venture capital in the Middle East, North Africa region. We invest in Turkey, invest in Pakistan, and Dubai is the hub.
Any other thoughts from, Fred, James, Khalid, maybe on this evolution? I think there's two things that I see, and then after this, maybe we'll open for questions. I think the question that I see is like, one, how do you increase deal flow, high impact deal flow, high quality companies? How do you support them? And on the other side, where are the opportunities where, not yet enough is happening, where we would want more of, the specialized VCs you mentioned, where we would want more of the founders to get, comfort to start. Any thoughts on that?
Yeah, I mean, just kicking off, I think like there's, anything that removes friction between sources of capital, individual investors or high net worth individuals or institutional capital, and those that are, should receive it. I think that's very welcome. And this framework is one step towards it. And like I mentioned earlier, I think, there's going to be a very rapid acceleration of opening up capital to founders from people who are interested in investing. You see kind of global shifts in opening up of capital markets, whether they're public markets, going downstream into private markets. I think that's happening more and more. So I think that's very, very interesting, and I think we all want to be at the forefront of that. In terms of sectors that we don't see enough of, I think something we're lacking in the region is more on the what you call sort of the deep tech innovation, which is really R&D driven ventures. So one example of that would be like, rather than would be artificial intelligence innovation, something in that space. So we see applications of that, but not real innovation in it in that sense. And there are a number of structural reasons for that. We don't have the full ecosystem for that in terms of like large research universities, that kind of thing. So it would be interesting as part of the overall development of innovation technology for that to start to evolve, but we still don't see much of that sort of deep tech startups that emerge, unfortunately. But that's something that we keep a keen eye on to see how that's going to emerge. I think the second is, we are a consumption-driven economy, meaning we don't come up with, we consume a lot, think of retail, but there isn't that much in terms of like homegrown brands across the spectrum, whether, FMCG or fast fashion or, you name it. And I think that's beginning to change, and that's really, really interesting in the way that e-commerce and online retail really allows you to kind of build a brand and reach a wide audience very quickly. And I think we're starting to see a lot of that happen very quickly here.
Excellent. Mariam, maybe just looking at the time, are there any questions that we want to maybe throw in now into the panel, but also maybe invite Chris, obviously, to join as well?
Yes, we are opening the floor for questions. We have one from Rita. It says, what are the requirements to be eligible for VC financing?
Is that?
I think that would be, yeah.
Is that a question addressed more to the VCs, I guess?
Yes.
Than to the framework?
So what are the requirements to obtain financing?
It depends on the sector, the stage, the geography. We look at Series A and Series B. We have sectors we prefer to others. So it depends. We look for traction, proof of concept, proven product market fit. I'm not sure what the venture is about to answer this question.
I think maybe one thing to chip in, Rita, and obviously, if you look at, every VC has a little bit of their own thesis of where they invest, how they invest, and I think, and also, how much capital they have, how much dry powder they're raising in new funds. So depending on that, it's good for you to kind of get a sense of who are the VCs that invest in the region into the type of business that you're doing, and then see how to get in touch with them, and that's typically kind of the process. Maybe that helps a bit clarify. Any other questions, Mariam?
Yes, there's one that's directed to you. What sort of I'm not sure which, Chris. What sort of checks and balances are required for a fund? and for international investors to confirm that they are professional clients.
I think that's for Chris, maybe. Chris, you want to take this one?
Yeah, sure. Happy to take that. So nothing different for a VC fund and fund manager vis-a-vis what we would expect of any fund manager operating in the centre. So, you know, we are very careful to make sure that investors of any kind, whether it's a fund or elsewhere in the centre, are onboarded in alignment with the FATF standards, essentially. So that's a key component to address kind of AML, financial crime risk. And then also in terms of your specifically the point about professional clients, the fund manager itself will need to ensure that those clients meet that criteria. So there's a certain criteria that we would expect, and the manager would need to address that. They can obviously use to support them third-party fund administrators, for instance, to go through that process. And you know, Fred's on the call today. There's an array of fund administrators in the centre that are well versed in our requirements. You wouldn't find them any different to international best practice. Hopefully that answers your question.
Thank you, Chris. Another question is, does DIFC or the DFSA have a role in helping fund managers to achieve exits? In particular, there is an issue with highly fragmented capital markets landscapes.
It's a good question. Sometimes I would like to ask a follow-up questions, but I think, look, like we're trying obviously as an ecosystem to support as much the startups, the funds, and I think there's more and more initiatives. Virtual Hub, you will hear more about what we're working on, will facilitate some of this. We've also seen through the Future District now, Nasdaq introducing sort of a new type of exchange, more focused on listing of SMEs. We need to see how that goes. I think globally we see secondary private markets evolve, and I think I would expect that coming here as well. But then there's more to be done. I think a lot, and maybe Khalid, Walid, you want to add to it. I think there's a lot that the VCs do also to pull in, you know, international or local families to look at the exit as well.
Thank you, Chris. Another question is, has the DFSA considered a self-certified sophisticated investor / high net worth regime to assist startup ecosystem?
Yeah, I mean, not just for VC, but we've looked at that over the years, and I've also seen it in other jurisdictions that I've worked on as well. Where that tends to be the case, where there's a self-certification, you can end up with retail in there, which is fine when investments are on the way up, but typically on the way down, then that's when the complaints will start to flow in. So I think it's important for investor protection that we do have that requirement in place for the fund manager and administrators accompanying them to go through that process.
Thank you, Chris. Another question. I think we're just short on time, so I'll just try to wrap it up. Does the VC framework allow the establishment in DIFC of GP fund manager that are managing funds with residency in foreign jurisdiction? If yes, what are the high-level taxes, such as VAT, applicable for the fund manager established in DIFC that will receive management fees from the foreign fund?
I won't get into the tax component there. That's not my domain. But what in essence we're looking to try and establish or facilitate here is funds and fund managers in the centre first and foremost in relation to the VC regime. For other components of the regime, the wider fund regime, it is possible to set up what we call external fund managers managing domestic funds, but we are focusing predominantly on the domestic component at this point. In terms of any tax-related questions, that's outside my remit.
Thank you, Chris. I think we have time. Just do one final question. What are the expectations or limitations once the VC fund is established as to where the capital is deployed? What if the fund is operated from the DIFC, but only 50% of the portfolio is local UAE or Dubai startup?
Yeah, I'm happy to take that. So in alignment with the rest of the fund regime. We don't have any criteria that directs you to invest any particular amounts or thresholds in Dubai, UAE, and nor do we prevent you from investing in any other jurisdictions. The one thing that I would caveat that with, obviously, is you need to be mindful again of FATF standards and certain jurisdictions that might be on different colours of lists on the FATF website. But that aside, all we expect is for you to disclose in your prospectus, the parameters in which you invest, and you may wish to disclose certain jurisdictions and investment types in there. But we don't have a criteria that either directs you to or not to invest in locally or globally.
Thank you, Chris. I think we are a bit over time now. So thank you to all our speakers and guests for joining in. We'll be sharing a copy of the presentations post-events. In addition to the webinar session, will be on our YouTube channel if anyone would like to rewatch. Thank you all, and we can also move some conversations offline if anyone would like to reach out to any of our speakers. Thank you all for joining in.
Thank you.
Thank you.
Thank you.
Thank you. Thanks, everybody.
Thank you.